What's up? We're about to make the video how to invest in stocks, as Amar and I have been investing in stocks for a little while now. Yeah, we're good to go. What do you got? Okay. So a lot of people have been asking us just in day-to-day life, like how do we invest in stocks, but they're not really talking about how to buy low and sell high or how to research. They actually want to know like what are the steps so they can invest in stocks. So that's what we're going to talk about today. How to invest, but not just how to invest accurately and smartly, but how to get your accounts and everything set up.
First step is you want to open up a brokerage account. You can likely do this through your bank, but depending on the bank that you're with, not all of them offer in-house services. So if you're with a credit union, something like Coast Capital, we've had experience with before, you might have to go through a third-party source like Questrade here, or Fidelity or E-Trade, something like that. But if you're with a larger bank like TD, you can do it through their web broker service or BMO's investor line. This will help you actually do the purchasing of stocks and do some research in there as well.
So basically, if you have your own bank account right now, say you have a checking account with BMO, right? You cannot just start investing from your bank account from BMO. You have to go there and get another brokerage account. You'll have to apply for it just like you applied for your original checking or savings account. And then after a few days or whatever, they'll send it in. Then they'll send you back like your password and everything for your online trading account. And then from there, you can transfer money from your checking or savings account, whatever you have, into your investing account because they're going to be totally separate banks. And then you'll be able to start investing from that.
And you can also open up some accounts like a TFSA account or an RSP, which will allow you to invest in the stocks, and the earnings that you do get from the stocks won't be taxed then by the government. So that is definitely a nice bonus there. So
research is going to be one of your most important steps for the process. So you want to pick a company that you like and or that you believe in their values with, so you know it's easy to follow them. That way, if you pick a company that you really dislike or whatever, you're probably not going to want to invest in their company. So if you find a company that you like what they're doing, so say for this example we're going to use Ford. This is like Ford's trucks and stuff. So if you like what Ford's doing, then you can research the company and see whether or not you think their stock's going to go up or down.
But then again, just because you like a company, it's not good to invest in that company for the sole reason that you do like them. You want to have a balance between like a company that you believe in their mission statement and their objectives, but you also feel like would be a good addition to your market portfolio.
And we're going to go more in depth with this, but basically you can also use trading games online, so that's like fake money. So you just kind of have a trading game and then it tracks whether or not you would have lost or gained profits based on the game, but you're not actually investing your own money.
Yeah, and when you do play these games, it's good to start with an amount that you would actually invest in real life, because if you start with like $1 million in the virtual game, it's not going to be a realistic depiction of what you're going to actually be doing in real life, because likely you're going to start with maybe like a couple thousand dollars, and if you're starting the game with $1 million, it's going to give you unrealistic expectations of what you're going to get in real life. A couple of the good ones are MarketWatch's virtual investing game and Investopedia's stock simulator. So those links will be in the description if you want to check those out.
So planning and purchasing. So once you have planned what you want to do, that's going to be your research for the stock. Then you're going to go online onto your online brokerage firm or whatever, and you're going to buy that stock. So basically you want to have a plan of whether or not you want to sell it in the short term or the long term. Some companies, say GE, General Electric, they're going to gradually go up in the long term, but it's a relatively safe stock. Or if you invest in like maybe a smaller penny stock, like say an industrial oil company, then their stock's going to be fluctuating a lot. So you want to really see whether or not you want to be investing in the short term or the long term.
You also want to have a good amount of diversity within your portfolio. So you want to have some blue chip stocks and also some that are a little bit more volatile, like the energy sector stocks there. So if you want to put some money into like a blue chip stock like General Electric or something like Under Armour, Apple, or Google or something like that will grow over time consistently, you want to have some money there, and you also want to have some money that's going to fluctuate a little bit so you can get some quick gains in your portfolio as well.
Yeah, keep in mind, basically if you're unaware of how stock prices work, they go up and down per share. So say you have $100 that you want to invest and you're investing in a very small company, so each share is worth $1. If each share gains $1, say in the month, then you will have invested in $100 worth of share, you'll have 100 shares, and that'll increase to $200. However, if you buy Apple per se, and you buy one share for $100, even if that share goes up by $50, you're only $50 ahead. Whereas with the little stock, you would have been $100 ahead if they just increased by $1, if that makes any sense. Yeah. So
after you do purchase your stocks, that's not the end of it right there. You still have to actively monitor this stuff. Not necessarily like every hour of the day, but you do definitely want to keep up to date with the company, see what's going on. If there's any like earnings reports that come out, you want to take a look at those to see if you're still invested in something that you still believe in.
now the best way to do this is through an app for your cell phone. So let me go at my cell phone 1 sec. Don't worry, it's casual as shit. So basically, I have this stock here, and you can see with the chart whether or not it's going to go up and down. You have your 1 day, 2, 5 years, and more. And then you can monitor this every day. So if we go to my stock here, these are most of the stocks I own. Some of them I own, some of them I don't. As you can see, the stock market went down today. So that's not very good. But every morning you wake up, you check this, you decide whether or not you want to buy or sell more stock, etc., etc.
Anyways, back to the video.
Alright, so we're going to give an example. Okay, this is the max year of Ford. So we said that we were going to use Ford as an example. Ford is really good. A lot of car manufacturers are good for an example because they fluctuate pretty high with the stock market in general. For example, S&P 500, that's a collection of 500 different big name stocks, big name companies, and that's going to be kind of your average of whether or not the stock market is going up and down. So car manufacturers, since they're so large, go up and down greatly with the stock market. So as you can see, if you remember in 2008, which is about right here, right where this line is, you had that big economic crash due to the real estate market in the United States, just crashed the stock market, everyone was selling. So we were going high for some time, and eventually the stock market needs to correct itself. So you're getting higher and higher because of greater, say, money in the economy. So people are buying more and more and more, and eventually, about every 10 years, the stock market has to crash. For example, the Great Depression was a big one. For those of you who saw Wolf of Wall Street in the beginning, like there was a big stock market crash where he lost his job. That's another one. So in 2008, which is a really big one, it crashed here. So that's the stock market correcting itself. Then when we get here, a lot of people...
That's the economy correcting itself right there, actually, but...
What did I say, stock?
No, you said you said the stock market correcting itself.
Yeah, sorry, the economy correcting itself.
Yeah, but this is the cycle of the economy. This is how it works.
So basically, the stock market kind of shows what the economy is doing. So a lot of people sold their stocks here, and then it went down to, I think the lowest it ever went down to was like $1.80 for a Ford. And then it climbs back up. So basically what you want to do when you're investing in stocks, it's pretty simple, but it's hard to get right, basically. You want to optimally invest low and sell high. But why isn't that possible all the time?
So one of the reasons that you can't always buy at the very bottom is because you never know if that is like the very bottom, or you never know if this is the very top. You're not always going to be able to invest in a stock once it reaches a good little Grand Canyon right here. So, but yeah, so just because the stock's rising, and you don't be like, oh, I'm not going to invest in that, because what if that stock continues to rise for the near future? Then you've still lost out on an opportunity, right? So this is where the research comes into play. You have to see like what current trends are and what past trends are to make an educated investment decision.
So basically, to maybe more complicate what his statement was talking about. So say you're here, right? And then this is where I said earlier, you want to buy here, okay? But you don't know whether or not this is a good place. For all you know, Ford goes bankrupt, it keeps on falling down. I mean, your little Grand Canyon is down here, and or you lost all your money because the company went bankrupt. Or say you're going up here and everyone's all excited because they're buying stock here, and then all of a sudden it crashes. So, maybe this would have been just the beginning of a bigger slope, right? But you don't know that up here, you don't know that that's the peak. And then next thing you know, boom, it crashes, you lost all your money.
Another thing would be is that say you're investing in like an oil stock or something like that, and its stock is like plummeted, it's like below $1 now. Just because below $1 doesn't mean you want to invest in that. Because for example, what if the world is starting to phase out oil as like an energy, as a form of energy? Then what? Like that stock's just gonna continue to go down. That company might be bankrupt, and you're gonna end up with an overall loss there, right? So
exactly. And this is just a 5-year plan. We're just gonna explain this a little earlier. We probably don't really need to now.
But this is just a closer view of what Ford stock has been doing in the past 5 years here.
Yeah, so when you say you want to buy stocks, say you want to buy Ford, you should be looking at their 5-year, their full length thing, the 1 year, all the different ones, so you can see the general trends. So you might see, okay, this trend here is going downwards, so there might be a slope, little canyon down here, but you know, it could be take off. So by looking at different years and timelines for the charts, it will give you a better idea on whether or not you want to buy. Does that conclude this video?